All right, here's the big question. Can a collection of, beloved but basically bankrupt retail brands actually rise from the ashes, especially with a celebrity CEO at the helm? Or is this whole story around Beyond Inc., ticker BYON, maybe just a classic investor trap? You're about to find out with us if Beyond is really on the path to a triumphant turnaround or if it's maybe staring into a pretty dangerous value abyss. Welcome to the deep dive. This is where we take all sorts of sources, research reports, articles, notes, you name it, and we really boil them down to the core insights, giving you that shortcut to being genuinely well informed. Today, we're diving deep into Beyond Inc. You probably remember them as Overstock.com. They made this, frankly, audacious pivot, buying the intellectual property of Bed Bath & Beyond. So our mission today, let's unpack the business itself, scrutinize the leadership, that's a big one, check out the financials, and try to figure out what this thing is really worth. Oh, and before we jump in, just a quick note. This deep dive, like a lot of our work, is powered by the incredible research from Stock Analytics AI. If you want more in-depth analyses like this one, definitely like and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on specific tickers for just $4.99 a month. And get this, over the next few months, they're covering all of the S&P 500 stocks, and members get exclusive priority access. Pretty cool. Or, hey, if you just want a one-off deep dive on a stock you care about, just drop a super thanks on the video. Okay, let's get started. Chapter 1, Business Analysis. Let's really dig into the core business itself. What makes Beyond Inc. Tick now?
Right. So the really fascinating thing here is that dramatic transformation they finished up in November 2023. It used to be Overstock, as you said. But then they bought the Bed Bath & Beyond intellectual property, just the IP, remember, out of bankruptcy, for only $21.5 million.
Wow, 21.5 million. That seems incredibly low for such a huge name.
Exactly. And that's the core question for you, the listener.
Oh.
Can these sort of resurrected brands, brought back online only, actually create sustainable long-term value?
So if they're not building stores, how are they planning to make money? What's the actual model here?
Well, they call it an e-commerce focused affinity model, which basically means owning a portfolio of different online retail brands that people hopefully, feel some connection to. But the strategy itself isn't traditional retail at all. It's what they call brand arbitrage.
Brand arbitrage. Okay, break that down.
The idea is basically that the brand equity, the value built into names like Bed Bath & Beyond over decades, with billions spent on advertising, was worth way, way more than that $21.5 million they paid, even after the bankruptcy mess. And the proof, maybe, is that almost all their transactions immediately shifted to the Bed Bath & Beyond website right after they relaunched it. It shows that name still has some serious gravitational pull with shoppers.
So they're betting that name recognition alone slashes their customer acquisition costs because people just search for Bed Bath & Beyond organically.
That's the hope. Capture that organic search traffic, convert it into sales, and achieve, a structurally lower cost to get each customer compared to starting a brand from scratch.
But how long can that last without the physical stores reminding people constantly? Doesn't that brand awareness just fade over time?
That is the critical question, isn't it? Maintaining that pull without the physical footprint is the huge challenge. Their product mix is heavily, heavily concentrated in home stuff, furniture, kitchenware, bedding, which makes sense given the main brand.
Right. And speaking of brands, what's the full lineup now? How are they positioning each one?
Okay, so Bed Bath & Beyond is definitely the flagship. Like we said, nearly 100% of transactions in Q1 2025. It's the main engine. Then you've got Overstock. They're trying to reposition that back to its roots, the treasure hunt for discount shoppers. Finding deals. buybuy Baby was also relaunched. They're targeting that very lucrative baby and kids market, obviously leaning on the name recognition it already had. And they also snapped up Zulily's IP for just $4.5 million that was focused on flash sales, mostly apparel and beauty. But interestingly, they sold off a majority stake in Zulily back in March 2025, which shows they're actively managing this portfolio, not just holding everything.
That Zulily move is interesting. But then there's this other kind of weird piece, right? This blockchain asset portfolio. Where does that fit in? It feels like a ghost from the old Overstock days.
Yeah, it's definitely a secondary component. Strategically ambiguous, you could say. It's a legacy from the former CEO, Patrick Byrne, and his big interest in crypto. Includes an equity stake in AZRO Group. Honestly, how it fits into the core retail strategy today, that's highly questionable. It seems more like a leftover asset they haven't quite figured out what to do with yet.
Okay, let's talk about their size and place in the market. They're small cap, right? TTM revenue around, what, $1.2 billion?
Yeah, about $1.2 billion trailing 12 months. And to put that in perspective, in the first quarter of 2025, their revenue was just 0.15%, like 0.15%
Yeah.
of the whole retail segment, including giants like Walmart, which is over 80%, and Target at 13%.
Wow. So a tiny fish in a massive pond. That highlights a huge scale disadvantage, doesn't it?
Absolutely massive. They're based out in Midvale, Utah. Pretty lean employee base, somewhere between 600 and 1,000 people, which reflects that asset-light, e-commerce-only model. Their stated value proposition, their marketing pitch, is helping you enhance everyday life through quality, style, and value. But the core idea relies on leveraging those powerful pre-existing brands onto an efficient online platform, avoiding all the high fixed costs of physical stores that, frankly, doomed the original companies.
Makes sense. And the market they're in, online home goods, it's growing, right? But what about the competition?
Yeah, the market itself is big and growing. Projections are anywhere from, say, 6.6% to over 12% compound annual growth through the next decade or so. And all the big e-commerce trends are relevant. AI, personalization, social selling, fast shipping, even things like augmented reality shopping. But the competitive landscape is exceptionally tough. Intense price wars, very low customer loyalty. They're up against Amazon, Alibaba, Walmart, Target, plus specialists like Wayfair. It's brutal.
Sounds like it. Are there any, regulatory hurdles or barriers to entry that might help them, or is it just more challenges?
Well, the biggest threat on the regulatory side right now is the potential for new U.S. tariffs in 2025. That's a huge risk for any retailer relying on imports, which they absolutely do. As for barriers to entry, look, anyone can set up an e-commerce website pretty easily. But building the scale to compete, that's incredibly hard. You need costly logistics, you have high customer acquisition costs usually, and it takes time, years even, to build brand trust. Beyond Ink is trying to shortcut that last one by buying the established IP, basically buying trust.
Okay, so let's talk competitive advantage, their moat, if they even have one. It sounds like it all comes down to those brands, right? That's the main pillar.
That's the central thesis, yeah. Acquiring distressed IP like Bed Bath & Beyond, buybuy by Builder, drastically lowers their effective customer acquisition cost. That's the bet. And, the initial spike in active customers after the Bed Bath relaunch offers some tentative proof that it worked, at least initially.
But you mentioned this before. Isn't that IP essentially a depreciating asset? Without stores, doesn't the brand value just fade away?
That's the really interesting and maybe scary part. Yes, without a physical presence reinforcing the brand day in, day out, that recognition will inevitably decline over time. It has to. That strategic partnership they announced with Kirkland's doing store-in-store concepts, that's a direct admission of this risk. It's a capital-light attempt to keep some physical touch point, try to slow down that brand decay.
Acknowledging the problem, then? What about other potential advantages, like cost structure or network effects?
Well, they have a huge cost disadvantage versus the giants because they just don't have the scale.
Yeah.
Their only real structural cost advantage is being asset light, avoiding those big rent and staffing costs of physical stores. But network effects in online retail, virtually non-existent. And switching costs, minimal. Loyalty is super fleeting. It's all about price, selection, convenience. People click away in a second. So their unique assets really are just that portfolio of brand IP and, well, the quirky blockchain portfolio. But again, its strategic relevance is dubious at best.
Okay, we've got a handle on the business model, the market, the potential moat or lack thereof. But a turnaround this big, it often hinges on leadership. Let's shift to Chapter 2, Management Evaluation, especially with Marcus Lemonis stepping in.
Right. The whole investment story for Beyond Ink now is pretty much dominated by Marcus A. Lemonis. He became executive chairman and the main boss, the principal executive officer, in March 2025. Obviously, his TV persona from The Prophet creates a lot of buzz, both excitement and, frankly, some questions. His actual track record running Camping World Holdings, CWH, has been, well, volatile, up and down.
And that raises a key question, doesn't it? He's still chairman and CEO of Camping World. How divided is his focus? Can one person really steer two complex ships, especially one needing such an intense turnaround?
That's a major concern for investors, absolutely. And it comes after a period of real instability at the top for Beyond. The previous CEO, Jonathan Johnson, resigned. Another exec, Chandra Holt, left. It's been a bit of a revolving door, which suggests, some pretty intense restructuring and maybe some friction. What they're doing now under Lemonis is executing a very classic turnaround playbook.
Meaning what specifically?
Aggressive cost cutting. They're targeting $45 million in annualized fixed cost reductions, slashing the number of products, the SKUs, and the vendors they work with, streamlining the whole organization. It's all about getting lean and efficient fast.
And Lemonis himself, he's very public-facing, right? Using Twitter Spaces, doing live events, that's quite a shift from the old Overstock days under Patrick Byrne.
Oh, night and day. Lemanis is very out there, very communicative. It's a stark contrast to Byrne's era, which was, let's be honest, pretty controversial, ending with that public war against short sellers and his abrupt resignation. So yeah, definitely a different style at the top now.
How are they allocating capital these days? Is it all just plugging holes, or are they making strategic bets?
Well, the foundation is still that opportunistic M&A, buying the IP of bankrupt companies on the cheap, like Bed Bath, Zulily, buybuy. Beyond that, they are making some targeted investments. They expanded their credit facility, and that IP sharing deal with Kirkland's Home is really pivotal. It signals a shift towards maybe an asset-light omnichannel model where they sort of outsource the physical store risk to Kirkland's. They're also investing in tech. They mentioned a big new relationship with Salesforce, trying to unify all their customer data across the different brands.
Makes sense. Now, for shareholders, no dividend, obviously. That's expected in a turnaround. Any share buybacks?
No evidence of recent buybacks. All the available cash is going straight into the restructuring effort, which leads to the crucial question for the long term. How quickly can they possibly turn around their return on invested capital, their ROIC? It was a truly dismal negative 31.75% in Q1 2025. Improving that metric, showing they can actually generate returns on the money they're investing, that's the central challenge.
Minus 31% ROIC. Oof. Okay, that's a perfect segue. Let's really get into the numbers. Chapter 3, Financial Analysis.
All right, so key metrics first. Market cap is hovering somewhere between, say, $385 million and maybe $412 million as of mid-2025. Puts it firmly in small cap territory, which always implies higher risk, more volatility. And it's crucial to remember this stock peaked at over $2.5 billion back in 2021, so it's been a dramatic collapse.
A huge collapse. And the revenue trends, they paint a pretty stark picture too, right?
Oh yeah, revenue has just fallen off a cliff after that pandemic era boom. Q1 2025 was $232 million. That's down a staggering 39.4% from the year before. Now, management claims this is partly by design. They say they're prioritizing getting profitable over just chasing top-line sales, so they're intentionally cutting unprofitable business.
Okay, prioritizing profits. Let's look at the margins then. You mentioned a green shoot earlier.
Yes, the gross margin. That's the most significant positive signal, really. In Q1 2025, it improved to 25.1%. That's a 560 basis point jump, 5.6 percentage points compared to the year before. So it does suggest that strategy of getting rid of bad sales is having some positive effect on the profitability of each sale they do make.
Okay, better gross margin is good, but does that mean they're actually making money overall? What about operating and net margins?
Well, no. Despite that improvement, they're still deeply unprofitable overall. The operating loss in Q1 was $23.5 million, and the net margin, still severely negative. The trailing 12-month profit margin is minus 18.06%, and the net loss just in Q1 2025 was nearly $40 million.
Okay.
So yeah, the gross margin bump is a positive sign for unit economics, but they are nowhere near sustainable profitability yet, still burning through cash on the bottom line.
$40 million loss in one quarter. That's a lot of red ink. It really does sound like a fight for survival. What about their cash flow? Are they generating any or just burning it?
Mostly burning it, unfortunately. Free cash flow, or FCF, has gone from positive back in the pandemic boom years to significant cash burn now. Q1 2025 showed negative $45.7 million in free cash flow. That kind of cash burn is a serious concern, especially for a company trying to execute a turnaround. It limits their runway.
Okay, so cash burn is bad. What other red flags pop up when you look at their financial stability?
Well, earnings consistency is basically non-existent. Highly erratic, deeply negative. The trailing 12-month earnings per share is a loss of $4.68. Their debt-to-equity ratio is pretty high, 1.54 as of the end of March 2025. That means creditors technically have a larger claim on the company's assets than the shareholders do. Not ideal. And the current ratio, which measures short-term liquidity, was 0.95 in Q1. Anything below 1.0 suggests potential challenges in meeting their immediate obligations. It's tight. And as we said, no dividend, which is totally appropriate here.
Right. So given all that, let's talk valuation. Price to earnings doesn't work because they have no earnings. What about price to sales? You mentioned it was low.
Yeah, the PS ratio is around 0.32. The median for the specialty retail sector is more like 0.75. So BYON is trading at a very steep discount to its peers based on sales, which signals, what you'd expect for a distressed company. It could mean potential upside if they restore profitability, but it also reflects the market's significant concerns. It's cheap for a reason.
So it's not necessarily a bargain, just priced for the risk. What about trying to figure out its intrinsic value, like with a DCF?
Right. A discounted cash flow analysis tries to value the company based on its projected future free cash flows,
Hmm.
discounting them back to today. It gives you a value independent of current market mood swings. But for a company like Beyond, in such flux, DCF is highly sensitive to your assumptions, especially the revenue growth rate. What do you possibly assume there? And you have to use a high discount rate to reflect the massive risk. Terminal value is also pure guesswork at this stage.
Understood. So with all those caveats, what kind of range did our educational DCF model spit out?
Given that extreme uncertainty, the model produced a really wide intrinsic value range, $4.50 to $10.50 per share. That range tries to capture everything from the turnaround completely failing to it being largely successful.
450 to 1050, that's a huge range. Okay, let's move on to chapter 4. Market sentiment. How is the broader market actually viewing Beyond Inc. right now?
Well, Wall Street analyst sentiment is pretty mixed, which really just reflects that high uncertainty we were talking about.
Yeah.
The price targets analysts have put out are incredibly wide, like $5 on the low end, up to $16 on the high end. The average target falls somewhere between, say, $7.20 and $9.12.
Cheer out.
And the general consensus rating is usually a hold or neutral. Nobody's really pounding the table to buy or sell aggressively.
And what about the news flow, the media narrative? What's the tone there?
It's almost entirely focused on the Marcus Lemonis turnaround story. That's the dominant narrative. Headlines highlight all the strategic moves. The Zulily deal, the Kirkland's partnership, the Overstock relaunch. Any positive news, like that gross margin improvement we discussed, gets framed as potential green shoots. But then, the declining revenue numbers and any executive departures, those fuel the more bearish side of the story.
Makes sense. What are the key market indicators telling us, like short interest?
Short interest is definitely something to watch here. It's notably high. As of mid-June 2025, about 15.07% of the available shares, the float, were sold short. That's about 8.5 million shares. That's a strong bearish signal. A lot of people are betting the price will go down, though it has come down slightly from the previous month. The days to cover ratio was almost 3 days, meaning it would take nearly 3 full trading days for all those shorts to buy back their shares if they wanted to.
15% short interest is quite high. What about technical indicators like moving averages? Technically, it's interesting. The stock price, around $7.14 recently, is actually trading above its 50-day simple moving average, which was about $5.55. That's generally seen as a short-term bullish signal. And it's also just slightly above its 200-day simple moving average, which is around $6.66. That 200-day is a really critical long-term trend indicator for many traders. If it can stay consistently above that level, it could be technically significant.
Okay, interesting technical picture despite the fundamentals. Let's shift now to Chapter 5, Ownership Structure. Who actually owns Beyond Inc.?
Well, institutional investors, the big funds, asset managers, they hold about 54.5% of the shares. There are 223 institutions invested, which shows there is definitely professional interest in this turnaround story. The top holders include names like Tidal Investments, BlackRock, Vanguard, Marshall Wace, and Morgan Stanley. What's interesting is a divergence in recent activity. Marshall Wace significantly increased their position by over 133%, but BlackRock and Morgan Stanley actually reduced their stakes. So conflicting views even among the big players. Diverging views among the institutions. What about insiders? The people running the company, are they buying or selling?
Insider activity has been overwhelmingly bullish lately, but it's almost entirely driven by one person, Marcus Lemonis. He made some really notable open market purchases, bought 400,000 shares back in May 2025, and another 157,000 shares or so in October 2024. As of early 2025, he owned around 0.83% of the company, worth over $3 million. When the top executive is putting their own money into the stock on the open market like that, well, that's usually seen as a pretty powerful positive signal for you, the investor. Shows real conviction.
Yeah, skin in the game. That definitely sends a message. Is the ownership overall pretty concentrated?
It's relatively concentrated among those top institutions, yeah. Which means it can lead to higher volatility if one or two of those large holders decide to suddenly build up a bigger position or conversely liquidate their holdings. Their actions can move the stock price significantly.
Got it. Okay, we've looked at the business, the management, the financials, the market view, the owners. Let's pull back for Chapter 6, risk assessment. Let's do a quick SWOT analysis to works. Strengths, weaknesses, opportunities, threats. What are the key internal strengths and weaknesses?
Okay, strengths. That iconic brand portfolio, which they got super cheaply. The asset-light business model, avoiding all those physical store costs. And you have to put Luminous and his turnaround focus in the strengths column, at least potentially. Weaknesses, though, they're severe. Deep unprofitability, high cash burn rate, a serious lack of scale compared to competitors, a weak balance sheet, high debt, poor current ratio, and that recent leadership instability before Luminous is still a factor.
Okay, significant weaknesses. What about the external side? Opportunities and threats.
Opportunities. They're playing in a large and growing market online home goods. There's clear potential for brand revitalization, bringing those legacy names fully into the e-commerce age. And that Kirkland's partnership opens up opportunities for omni-channel expansion without taking on store risk themselves. Threats, though, are also significant. Intense competition from much larger, better capitalized players, the constant risk that the brand relevance of that acquired IP just erodes over time, and just massive execution risk pulling off a complex, multi-brand, multi-channel turnaround like this is incredibly difficult. So many things have to go right.
And beyond those company-specific things, how do broader economic factors play in?
Well, as a retailer selling mostly discretionary stuff, things people want but don't necessarily need. BYON is highly sensitive to the overall economy. If inflation stays high, it eats into people's purchasing power. If interest rates go up or stay high, it makes people less likely to splash out on big-ticket items like furniture. These are major headwinds they can't really control.
Right, the macro environment is tough. But you mentioned one specific, potentially huge external threat earlier.
Yes, the elephant in the room. Potential broad U.S.-imposed tariffs in 2025. This is a really big one to watch. Multiple reports suggest that home goods, furniture, appliances, core categories or beyond, are specifically targeted for potentially significant tariff hikes, maybe 25% or even more. Since they source heavily from Asia, tariffs like that would directly hit their cost of goods sold. Hard. So what does that mean for you? They face a horrible choice. Either absorb those extra costs, which would crush their already fragile gross margins, or pass the costs on to consumers. And passing them on would almost certainly hurt demand in what's already a very price-sensitive market. It's a potential nightmare scenario for them.
A potential nightmare scenario indeed. Okay, let's bring this all home. Chapter 7. Conclusion. Let's synthesize everything. What's the bull case versus the bear case here, boiled down?
Okay, the bull case. It really rests on that brand arbitrage idea they bought invaluable IP for pennies, giving them a potentially durable edge in getting customers cheaply. It's also definitely boosted by Marcus Lemonis's leadership, his reputation as a turnaround guy, and crucially, his significant buying of the stock with his own money. That matters. And lastly, those tangible green shoots we talked about, especially the big jump in gross margin year over year. It suggests the basic economics per sale might be improving. And it's a big if they can leverage those brands effectively, execute the plan, and start growing revenue again profitably, then the asset-light model could promise high returns down the road.
Okay, that's the optimistic view. Now hit us with the bear case. Why might this all go wrong?
The bear case is fundamentally rooted in their incredibly precarious financial position. They are severely unprofitable. They are burning through cash at an alarming rate, which gives them a limited amount of time, a limited runway to fix things. The balance sheet is weak, too much debt, not enough short-term liquidity. They operate at a massive scale disadvantage against ruthless competitors who can outspend and undercut them. Plus, the turnaround strategy itself is just incredibly complex. It's fraught with execution risk. There's been leadership instability. And hanging over everything is that looming threat of potentially crippling tariffs. There's just so many ways this could fail.
So putting it all together with the valuation, remind us of that DCF range again.
Our educational discounted cash flow model gave a very wide estimated intrinsic value range of $4.50 to $10.50 per share. That range reflects the huge uncertainty, capturing scenarios from total failure up to pretty decent success.
And where does the current stock price sit within that range?
Well, as of early July 2025, the share price was around $7.14. So it falls squarely within that estimated value range, smack in the middle, basically. What that suggests is the market is currently pricing in both the significant potential rewards, if the turnaround works, and the substantial risks that it might fail. The current price doesn't seem to offer a huge margin of safety for a cautious, value-oriented investor. But it also doesn't seem excessively pessimistic, given the challenges. At the end of the day, the investment thesis here hinges almost entirely on your personal confidence level in Marcus Lemonis and his team's ability to execute an extremely difficult turnaround in a brutally competitive industry, potentially facing significant tariff headwinds. It's a high-stakes bet on execution.
A high-stakes bet on execution indeed. So what does this all really mean for you listening? It leaves us with some big questions, doesn't it? In today's world, dominated by e-commerce giants, how much does a famous old brand name truly matter if it doesn't have that physical store presence anymore? And maybe more importantly, how much does the narrative around a celebrity CEO, however compelling, actually change the fundamental odds for a business that's struggling this much? Something to think about. This deep dive into Beyond Inc., ticker BYON, was powered by the research from Stock Analytics AI. If you found this analysis useful and want this kind of deep dive capability for your own investment research, remember, you can become a member of the Stock Analytics AI YouTube channel. It's just €4 a month. Members get priority deep dives on tickers they request, and like we said, they're covering all the S&P 500 stocks over the next few months, with members getting exclusive early access. Or if you just want a one-off deep dive into a specific stock you're interested in, you can always just drop a super thanks on the video. We appreciate the support. And finally, the important reminder. This analysis was generated by an AI system. It's for educational and informational purposes only. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.